Hello traders, thank you for joining us this afternoon. I'm Mike Sedek, I run retail trading here at Lightspeed, and I have with me today Evan Lazarus. He's the Chief Knowledge Officer at T3Live.com. So Evan's going to drop some knowledge on us about using time frame analysis for high probability trades. If you guys aren't familiar with T3 Live, they are one of our premier education providers, and we formed such a close partnership with them because their content is tailored specifically toward the type of client that we at Lightspeed service, and that's professional traders and those looking to generate real income from trading. This presentation is going to be recorded and uploaded to our online webinar library, so you'll be able to see this as well as most of our past webinars online at lightspeed.com/webinar. So if there's anything that you missed or you just want to go back and review the material, that's where you can find it. And our mandatory disclosure, just please keep in mind that this presentation is for informational purposes only. So that means that nothing that we present today should be construed as investment advice or a recommendation by either Lightspeed or T3 Live to buy, sell, or hold any specific securities. And since we don't know everyone's investment objectives or risk tolerance, none of the strategies that we're discussing today are recommendations or endorsements. And of course, we want to encourage you to ask questions as we go through the presentation, and you can do that by typing them into the webinar chat box as we go along. So, Evan, if you still have a voice left after talking for 3 days at the New York Traders Expo, I'll turn it over to you.
All right, perfect. Thanks, Mike. I want to, before I start, I just want to thank everybody at Lightspeed, the great Mike Sedek and all his Lightspeed cohorts over there. We have a great relationship, and for those of you that aren't aware, myself personally, as well as all the traders in my broker-dealer, which is T3 Trading Group, are all trading on Lightspeed software, if that gives any indication of how highly we hold their platform and what they do for us. So with that, let's jump right into it. For those of you that had the privilege of attending the New York City Traders Expo this weekend, perhaps you saw this as I did make this presentation there. If you weren't there, hopefully this will be new and fresh and interesting. The last webinar I did for Lightspeed a few months back, we focused on a psychology topic. So we figured we'd mix it up this time, and we talk a little bit more about technical analysis and how we apply it. So we're going to talk today about time frames, and this is probably one of the more challenging aspects to what we do. But if you can take the time to learn the process of what I'm going to cover today, it can be highly rewarding, and we're going to get into that in a little bit. And it's not a strategy that's a buy now or a sell now. It's really more about your thought process, because 80% of trading, day trading, swing trading, active trading, however you want to position yourself, is really more about how you think and how you perceive a trade. And I found that for me personally and for most of my traders, the easier that we can make it, the easier that we can structure our thought process, the easier this business ultimately becomes. Trading as a profession, as many of you know, can be very, very challenging. And part of the reason that I think there is a separation between what makes a good trader good and a bad trader bad, it's really more about what goes on in between your ears that matters the most, that differentiates good from good and bad from, bad from good. So let's go into the slideshow a little bit here, and then we're going to do some questions after. But the first slide really says everything, and it's in the first line. Keep it simple. And I want you to remember that term, because I think many traders go through the technical analysis path, especially short-term traders, again, being day or swing or what are you, they overcomplicate the process. They make this business way harder than it should be or it needs to be. And when you overcomplicate the process, getting the results can be very, very challenging. So here we have our disclosures, just a little bit about, T3 Live, as we are an education company and not a broker-dealer. We do have an affiliation with my broker-dealer, which is T3 Trading Group. Not very exciting stuff. Okay, so let's talk about time frame analysis and alignment. We use multiple time frames when we trade. We look at a stock or an index and we view it through a microscope. And we can zoom in that microscope, and we can zoom out. We can look at something with granular detail, real close up, and we can also look at it from afar and get a more, a clearer picture without seeing every little ebb and flow. So typically, most traders that I've taught, most traders that have come through, T3 Live's educational doors, generally get stuck in one time frame. For those of you that day trade, typically most of you live in 5-minute charts. You're taught somewhere along the line that you need to look at 5-minute charts or some small segment of time because that's really where the low-risk trades are. And while that can be partially true, it also can partially screw you up in a very, very bad way. Trading a higher time frame gives a trader both a longer-term outlook and a bigger time window. So basically what we're saying here is the higher the time frame, the higher the risk. The smaller the time frame, the smaller the risk. Generally, traders that operate off of higher time frames will stay with trades for longer durations of time, and traders that operate off of smaller time frames will operate for shorter durations of time, which is basically what this slide says. So higher time frames, more risk, more reward. Smaller time frames, smaller pockets of risk, smaller pockets of reward. Is there a better or worse? No, there is not a better or worse. It's a function of what you're trying to, what your trading objectives are, in essence, in what time frames you operate. So let's talk a little bit about alignment. And we're going to get in, we're going to look at some charts here. So I want to try and get through the sort of the classroom stuff in a more rapid manner so we can take a look at the pictures, because with this particular exercise, this particular piece of education, picture is worth more than $1,000. It's worth a lot of money here. It's very, very valuable because the pictures do tell the story. As technicians, we look at charts. Charts are visual representations of the movement of price. Chartists, technicians, whatever you want to call us, we study the movement of price. My primary indicator is price. I make my money as a trader from the movement of price, so it's what I care about the most. So we have two separate time periods. We have execution time periods and analytical time periods. We use both together. So active traders, what we consider more day traders or short-term traders, will primarily rely on execution time frames more frequently to find their trades. Longer-term traders, swing traders, investor types will predominantly use longer analytical time frames for researching their potential setups. And at T3 Live, we teach most of the day traders to operate on the smaller time frame, 5 and 13-minute time frames for active trading, but not always. When you're trading larger time frames, smaller time frames can be used for entry and exit. So let's sort of jump right into it here. And what I have here is I have the same symbol. So in the top you can see the symbol, but the symbol is really irrelevant. I don't want to, it's irrelevant what the stock we're looking at here. What's important here is the picture. So in all three pictures, you have the same stock. And we're going to start with the left. This is a daily chart, and you can see every candlestick represents one day of time. On this chart, what's important to notice here is not the price and not the actual candlesticks, but it's the moving averages. So we have a red and a blue line here. We have an 8-period EMA, which is our blue line. We have a 21-period EMA, which is our red line. And below we have a 200 EMA, which here is this gray line. And you can see up here on the top left, it's sort of your key right there. Now what's important here is you have a rising 8 above a rising 21 above a flat 200. As you know, or as you may not know, that's a representation of something that is bullish, okay? We're in an uptrend. You have rising moving averages. From left to right, you have an 8 above a 21 above a 200. That's what a technician would consider something bullish. You have a stock that has pulled back to its rising 8-period MA. And you can see what we have here. We have it labeled daily buy at rising 8 EMA. This is something the traders are trained to look for here on the daily charts. Let's hop to the middle here. Now we're looking at a smaller time frame. This is what we call an analytical time frame. It's a 34-minute chart. On the 34-minute chart, you have a stock that breaks out. You see this big green bar, gives you a very controlled 1, 2, 3 bar pullback into a rising 8-period MA. So now you have what we call alignment. Your time frame, your moving average here on the 34-minute is now rising. You have a rising 8 above a rising 21. And on your daily, you have a rising 8 above a rising 21. The chart to the left and the chart on the left and the chart in the middle align. Two time frames, a higher time frame and a smaller time frame align. They're both telling you the same thing in terms of direction of the moving average, sloping upward from left to right, holding above an 8-period EMA, an 8 above a 21. Now let's look at the chart to the right. This is that same entry. Notice right here, this green bar up, 3 bar pullback. I'm going to go all the way down here at the bottom left of the chart. Is this same picture in the middle. Big up bar, 3 bar pullback. So you have the same look, and you can see exactly what happens to this stock. Okay? Notice the result, a day and a half, 2 days later, you have a stock that goes significantly higher. You're trading with the trend. This is an example of time frame alignment. How a higher time frame and a smaller time frame align, you trade with you trade in the direction that those align. In this case, it's up, and you can see the results a day and a half to 2 days later. And we're going to look at some more of this. Okay? Again, the picture to the left, you have a stock with rising moving averages, a rising 8 above a rising 21. Notice the slope is going up from left to right. That tells us what direction is the path of least resistance. Very important information. You can also see pullbacks into the 21 have been areas of support or are supporting the stock and what we call buy setups. So we have a recent daily buy setup at a rising 21 EMA. Stock pulls back to the average and boom, gets bought again. This is what we call buy setup. So we can see from the daily chart there are buyers and the stock is in an uptrend from this picture. Let's look at the chart to the middle. Again, let's go down. We're looking at more detail. This is a 34-minute chart, so we're looking at more. Every candlestick represents 34 minutes of time. And you can see in this picture, again, big up move, and the stock consolidates, and our averages actually start to pinch together. We still have an 8 above a 21. Now, this is a great example of a picture because this is very, very typical of what day traders do. Day traders will see a stock start to turn down, which you can see the stock does on this time frame, and they'll look to short the stock because they think it's breaking down. When in reality, look at the result. Let's move to the picture to the right. The uptrend continues because although the stock has pulled back, we still don't have, your time frames are still bullish on the chart to the left and the chart to the middle, and the outcome is bullish. So by staying with the aligned time frames, you put yourself in a much higher probability of a trade. Let's continue. And we're going to keep doing this, and then I'm going to actually pull up some live charts, so we're not looking at, slides of things that haven't happened recently. We're going to look at the market as it stands today to put some practical application into this. This is really more concept and theory, and hopefully I'll have some time towards the end of this to go through and look at some real charts, things that happen even as so far as today. Again, looking at two different time frames. On the chart to the left, you have an analytical time frame, a 55-minute chart. On the chart to the right, you have a 3-minute chart, an execution time frame. Analytical on the left, execution on the right. The chart to the left, you have downward sloping MAs. You have an 8-period that is declining. Notice the slope is going down from left to right. The 8 below the 21. These are what I call the railroad tracks. You have parallel lines running side by side against each other. The 8 is basically parallel with the 21 and sloping down. That tells us a lot of information about what's happening here. Our analytical time frame, our higher time frame, is telling us a picture of weakness. The stock is getting sold. T3 Live traders are trained that when they see this, they're going to want to look to short bounces back into the average. Notice 1, 2, 3 bar bounce, back to the average, sold. Bounces back to the average, sold again. Okay? So what we have here is we have what we call sell setup, and the stock is continuing lower. The trader missed the initial entry and wants to trade the move down, but doesn't want a wide stop above the recent pivot high. We're going to call this tail the recent pivot high. So let's take a look at the same chart, but on a 3-minute time frame. So on the 3-minute chart, again, notice the similarity between the 3 and the 5. Your time frames, your moving averages align. Your 3-minute chart is railroad tracking down, as well as your hourly chart is railroad tracking down. These time frames align. This is a trade that will have a much higher probability of following through in the direction of those averages on the higher time frame. So on the 3-minute chart, again, large move down, a 3 to 5 bar bounce with a tail right here into a declining average is an area where you want to look to get short. Notice what happens thereafter. Traders are trained at T3 Live to take this kind of setup. They get involved with it up here into the tail, into the average, and the result is a follow-through or another downward move. So we are going to use the hourly for clarity. We see the direction, we see the bounce on the hourly, and then we're going to go down to the 3-minute chart or a smaller execution time frame to find best execution or best entry. Dropping down to the 3-minute gave a lower risk follow on entry. So basically what we're saying is, using a small time frame, we can carve out an entry in this stock. Notice here on the bounce into the $65 area, a trader looks to get short on a 3 or 5-minute chart, and you get a nice, strong downward move. You're trading with the trend on a stock that has alignment. Notice your time frames, analytical, and execution are aligned. Now again, this is not easy stuff. Because we cover this in a 30 to 45-minute window does not necessarily mean that you're just going to go out and get it. This takes practice. It takes time to understand this concept, but once you train your brain to think in terms of alignment, you're going to train your brain essentially to think in terms of higher probability, lower risk, easier money type of trades. Trading with the trend versus trading against the trend. Now, I know plenty of traders that can counter-trend trade and make a living doing it, but I'm going to tell you right now, it is a much more difficult type of trade that requires a lot more precision and has a much higher failure rate. And we're going to take a look at that. So let's take a look at another example here. Again, we're looking at the same symbol, the same stock, but we're comparing 2 different time frames. So on the chart to the left, you have an execution time frame. You have a 5-minute chart of U.S. Steel, okay, symbol X. The 5-minute chart shows us from our averages that we were bearish, declining averages. They pinch right here, what's known as a pinch, and they cross up and they go bullish. Okay? So in the 5-minute chart, it tells us that the downtrend looks like it has subsided, and potentially now something is changing as we have gone from bearish to bullish. Okay? Now let's look at the 34-minute chart. This time frame, again, same symbol, same time, shows us that we still have declining moving averages on an analytical time frame. The 34-minute chart is analytical. The 5-minute chart is execution. So the analytical says this is still a weak stock with declining averages. The trend, as far as we can call it in this picture, is clearly down. The stock is being sold. Our pivots, notice our pivots. Pivot up, down. Pivot up, down. Pivot up, down. Okay, so there's selling going on every time the stock snaps back into the average, which is sloping from left to right in a decline. Okay, so here's where traders run into problems. The chart to the left is bullish, and the chart to the right is bearish in terms of our moving averages. Now, these time frames do not align. This is a trade that I teach traders not to take. Because if you're only looking at a 5-minute chart, you're going to start to think, hey, I should be long this stock. Something's changing. This may be a good long. But if it's not a good long in conjunction with the higher time frame, the chances of this stock going higher are significantly low. This stock has a high failure rate of going higher. Now let's take a look at that. Here's the same here's that 5-minute chart. So this is the execution time frame. This is where it crossed and went bullish. Okay? So notice what happens. It then realigns over here, goes back to bearish, and the stock falls apart. Now, why does it do that? It does that because the higher time frame, which you see here on the right, was bearish. The bigger forces, the analytical time frames, we're going to call those the bigger forces. If they are pointing down, that is what will have a much greater impact on the stock. Your short-term charts will constantly flip between bearish and bullish, but when they are fighting against a downtrend, it is going to be a very hard trade. Trading against the higher time frame, as it says right here in the slide, is a lower odds trade. And we're going to look at that. Failed 5-minute buy setup. So while the stock went bullish and pulled back to the average, notice it fails and continues lower and the stock breaks down again. Okay. Let's take a look at another symbol. And again, this is what we do in our active trader program. This is like constant just evaluation of charts. The more charts and the more setups you can look at, the more you're going to learn to familiarize yourself with being able to do this. Are my time frames aligned? No? Okay, that's a trade I want to pass up. Are my time frames aligned? Yes, they are. I have a bullish execution time frame. I have a bullish analytical time frame. This is a trade I want to look to be long. I have to now find an entry, a place to enter the stock. What we're doing is we're making the process a lot simpler. So by going out and trying to find symbols that are aligned, what you're essentially doing is you're trying to find stocks that are trending. You're looking for symbols that are making higher lows and higher highs in an uptrend. If you find symbols that are aligned and sloping downward, essentially what you're doing is you're looking at symbols that are making lower highs and lower lows and trending lower. The forces are pushing it down or the forces are pushing it up. You are putting yourself in a position where you are going to gravitate towards A, finding the right direction to be in, and B, trading with the trend, which I can tell you from 15 years of experience is a much easier trade than counter trend trading, without a doubt. Okay, so let's take a look at this picture. Again, you have a 5-minute chart to the left and a 34-minute chart to the right. Execution to the left, analytical to the right. Our analytical chart, our higher time frame, shows a picture of down. An 8 declining below a 21. So we can see the forces here in this time period are telling us a story of weakness. This stock is being sold. A 3 to 5 bar bounce into an average, boom, gets rejected. The stock is going lower. Now let's take a look here at the 5-minute chart. The 5-minute chart, again, downward sloping averages, an 8 below a 21. So we have alignment. Our moving averages are pointing the same way, down, down. Our time frames are aligned. On the 5-minute chart, the execution time frame, you get what is now a 4-bar bounce into the averages. The stock has broken down and has now found a short-term bottom, putting in again, a bounce, a multi-bar bounce into a declining average. So the question is, looking at multiple time frames, would you take this sell setup? Here's that same 5-minute chart. Here's that same 4-bar bounce. This red bar undercuts a prior bar's low. That's our entry signal. Our stop is a penny or two above this pivot high. And notice the trade goes right back down. So what we're saying here is trading with the higher time frame increases the odds of a trade. This stock, after going in your favor, has put in a lower pivot high. And then we talk about trailing stops. We're not going to talk about that here. And where would you adjust those stops? We're not getting into stops because it's a whole separate conversation. But what I wanted, the point of the exercise here is notice that getting short here after a bounce results in what potentially is a good trade. Trading with the trend, selling a bounce on an execution time frame into a declining average. All right, so that goes through, that takes us through this presentation. I now want to take a look at some charts, and I'm going to set that up for you in a second. We have a free 30-day online home study course. If you go to t3live.com/edu, you can find that material. Again, it's t3live.com/edu, and it's a nice sample of what our our education suite looks like. This is just one small part of the Active Trader program. And what I want to do here is I want to shut this down for a second, and I want to look at some charts here. Let's actually go. Let me take this over here. Let me share my. Okay, I've now moved to what is called a split screen. And you can see, I assume you can see two charts, a execution chart on the left, an analytical chart on the right. And what I want to do is I want to look, I'm just going to throw up some random symbols. I want to show you an example of how I go about looking for a trade and why I think alignment is so important. So what I do is I start with my daily chart. So I'm going to make this chart here a daily chart. And we're going to look at a stock as an example here, just for example. We're going to look at a stock that I was in today for a trade. And I'm going to explain why so you understand. So this is RIM. We all know RIM's been in a bit of a downtrend. This is a daily chart. You can see, it is an example, notice the power of the trend. Every time the stock snaps into the 21, it fails. Snaps into the 21, fails. Snaps into the 21, fails. Finally, we get a little bit of a whipsaw. The stock turns back bullish, but then over here you can see it's now turned back to bearish, riding under the 8. Notice how the 8 period right here acts as a blanket, a little bit of resistance, starting to push the stock down. Okay, so that's powerful information. The trend right now, as we see it, is down. My averages are down, and the 8 is acting like a blanket of resistance above current price. So now let's look at some of our smaller time frames. We're going to take our microscope and we're going to get a little more granular. Our hourly chart, or my 55-minute chart, down. You can see my moving averages right here. I've gone bearish. Railroad tracking, parallel lines down. My 34-minute chart, down. My 13-minute chart, down. So on and so forth. This is perfect alignment. All my time frames are pointing the same direction and telling me the same thing. So this to me represents a symbol or an opportunity that presents low risk. I can tell by having alignment that all the forces are committed to pushing this stock lower. It's now my job to look for entry on a small time frame. So I'll use my 5-minute charts. Here's a 5-minute chart, and you can see the bounce this morning into the declining 21, sold. Bounce into the average, sold. So on and so forth. Okay? This is how short-term traders need to learn to think before putting themselves into a trade. I know way too many traders that get into trades for the wrong reasons. And we're going to look at something that's not aligned. So let's take a look at the spiders. Let's just take a look at the broader indexes, the S&Ps. Okay, so we have here the daily chart. Again, I'm starting with the daily. I can see I have railroad tracks going up. That is a chart of strength. I know the trend is up, and I can see that buying pullbacks into the averages have proved to be very, very beneficial. Stock pulls back into the averages, it gets bought. I'll use my little pencil tool here. Pulling back, getting bought. Pulling back, getting bought. That general concept, okay? So we can determine the trend here is clearly, in this time frame, up. That's powerful information. Now let's take, again, our microscope and let's look at an hourly. Well, our hourly chart has seemed to have flattened out, okay? I don't have those same parallel railroad tracks up right now. My 34-minute chart actually has turned and gone bearish. So my time frames do not align. I have non-alignment in my time frames. So what does that mean? That doesn't necessarily make this stock a short. What it means is that there's really no reason to be here, right and right now. At some point at a later date, when the time frames, the smaller time frames, realign with the higher time frames, it will be a lower risk, higher probability trade. So the valuable part of time frame analysis isn't just telling you what to trade. Okay, so we look at an example like research in motion today, where you see alignment. That's a story where it says, okay, trade me, please trade me. You know, the stock has to tell you, hey, you need to trade me today because I have alignment. It's a higher probability trade, represents lower risk, trade with the trend. Whereas we look at a stock like the spiders today, and again, I'm not making recommendations for tomorrow, I'm just showing you examples, where it's that we don't have alignment. It's telling you, hey, don't touch me. Don't trade me today. There's no reason to trade me. It's harder money. So the way I always teach traders to think is you need to have a reason to make a trade. My reason is usually because my time frames are aligned. When you're trading and you don't have that alignment, you are putting yourself in such a enhanced, difficult, lower probability trade. And most traders never learn this simple tool. So what it does for me is not only it tells me what to trade, but most importantly, what it tells me is what not to trade. And I can't tell you the latter is way more valuable for a trader than what to trade. What not to trade will make you so much more money because it'll save you that much more money. You know, I work around a lot of traders. I have a trading floor, and I deal with traders all the time. And I'm always hearing traders, I'm long this, I'm short this, I'm doing this, I'm doing, and I'm constantly saying, you know, are these time frames aligned? So I know that I am constantly going after the highest probability situations I can. Doesn't mean I'm always going to be right, but think about it in this way, and this is the way I explain it to most people. If you're playing blackjack, the game, most people lose the game because they bet every hand. Think about this. For those of you that play blackjack, you're sitting at a table, and again, I'm not trying to compare gambling to trading, but I want you to think in terms of probabilities. Okay, just put your mind in terms of probabilities for a second. If the dealer puts cards on the table and you have a 20, you have two 10s, and the dealer's showing a 6, and the dealer says to you, would you like to bet this hand? For those of you that are blackjack players, you're thinking to yourself, you're damn right I want to bet this hand, because the balance of power has dramatically shifted to your favor. It's a much higher probability situation. I don't know statistically what the odds are, but you probably have an 80% chance of winning the hand. Doesn't mean you have a 100% chance of winning the hand. Doesn't mean the dealer can't or won't get a 21. We've all had that happen to us at the blackjack table, the old back door. But you know, statistically speaking, the balance of power is now dramatically in your favor, and that changes the game. So let's look at it again. Let's say the dealer puts two cards on the table, and you have a 14, and the dealer's showing a 10. And the dealer says, would you like to bet this hand? Most of you would say, no. The balance of power is definitely not in my favor. The odds incredibly favor the dealer. This is a hand I don't want to bet. It's the same thing in trading. It's 100% the same thing in trading, because what I'm essentially teaching you and talking about is thinking in terms of probabilities, especially if you're a day trader or somebody who trades frequently. Put yourself in the best situation you can. Teach yourself to think about, is this trade the highest probability trade for me right now? Do my time frames align? Yes? Okay, then I should be trading with the trend, and I should be, if in an example, let's say the trend is up and the time frames are pointing up, I should be thinking in terms of buying pullbacks on my execution time periods into a rising moving average, or vice versa on the downside. And by doing that, you are going to see a dramatic shift in terms of your consistency as a trader, and you know, the way you teach yourself to be patient to let trades come to you. It's a very different business and a very different process if you think in terms of probabilities and alignment than just hoping for the best and saying, oh, I think this stock's going to go up today, but I don't know, and we're just going to go for it. I learned very early in my career, which, by the way, I almost traded myself out of this business because I didn't understand this concept, that when you get into a trade and you hope and you wish and you pray, you get the hell out of that trade. So with that, I'm going to look at one more. We can do one more here. We'll take a look at another symbol. Let me think here for a second. What do I want to look at? Let's look at everybody's darling Apple, okay? Because I think it's such a widely popular stock. So our daily chart tells us a story of bullishness. Railroad tracks going up. The stock, as we all know, has been bought on almost every pullback. Notice the pullbacks here, 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 and even here. Okay? So we know that on the daily chart, this 8 period represents an area of significant support. But let's take a look at our hourly. Our hourly is now bullish. Okay? So we have alignment between our hourly and our daily. Let's take a look at our 34-minute chart. Again, bullish, rising, okay, bullish. Let's take a look at our execution. Well, as it stands right now, our 13-minute chart has flattened out, and our 5-minute chart has actually gone bearish. Notice the cross right here, the 8 is now below the 21. My time frames essentially don't align. Now, it doesn't mean they won't realign tomorrow, but this is a trade that I know I want to be hands-off. That is, in and of itself, substantially powerful information. It tells me what I should not do. When my time frames realign, and at some point they will, either up or down, I know that there will be a much better, lower risk, higher probability trade. Because if you can teach yourself to do this, you're going to teach your, essentially train your brain to think in terms of high probability situations. And when you learn to do that and do that consistently, you're going to take so much subjectivity out of your trading. You're going to take a lot of randomness out of your trading. And you're probably going to take, for those of you that aren't as consistent or as profitable as you want to be, you're probably going to alleviate or help alleviate a lot of that inconsistency and turbulence in your P&L if you suffer from that syndrome. Most traders suffer from that syndrome because they just don't understand the value of trading alignment. I can't stress it up. I hope you can understand the enthusiasm and passion in my voice, because I live and breathe this stuff every day. As much as I have an education company and I teach professionally, I trade every single day. I still put my X's and O's out there every single day, and I'm still trading this market just like everybody else. So what I do when I trade, this is essentially a very, very large part of what I do, and it's something I rely on very heavily because I know that it's going to put me in the best possible situations. And like I said earlier, even more important than that, it's going to keep me out of a lot of situations I probably shouldn't even be in. So with that, I'm going to let Mike open it up for some questions, should there be any.
Okay, yeah, guys, if you have any questions, please type them in now. I answered many of the Lightspeed related ones throughout the presentation, but if you have anything to ask about what Evan presented, please take a moment to put it in now.
I'll put the slideshow back up.
I think, Evan, you must be the world's greatest presenter, and obviously that's why there are no questions that were left unanswered.
Perfect.
All right, so guys, with that, if there are no other questions, we'll end it here. Thank you, everyone, for joining us. Evan, thanks for another wonderful presentation, and looking forward to having you back with us.
Thanks for having me, Mike.
Have a great night, everyone.